Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is industry veteran and hybrid product expert, Butch Boley. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, Butch and I are talking about how to pay for long-term care. We'll walk you through the most popular options that seniors are using to deal with their lifestyle changes. Well, Butch, let's talk about it. There's ways to pay this. Most people are paying it out of their pocket, and it's costing them their entire inheritance. They're burning through assets. We're doing reverse mortgages. And we're running through all the equity positions and all our portfolios just to pay for long-term care. And when I look at the statistics, a lot of our people that are lower middle class all the way down through the poor are going to Medicaid, and really Medicaid it was never really built to take on long-term care assisted living. So it's kind of a confusion, because out there right now, we know we have the need. We have no problem debating it any longer. I just don't know how to pay for it.
Exactly.
Well, why don't you walk us through how it actually works on an individual policy?
Yeah, it's really pretty simple, Steve. The individual pays the insurance company either a monthly, annual, or semi-annual quarterly premium. Upon a triggering event, which is typically 2 of 6 ADLs, that's when the insurance company will either do a reimbursement to the client or an indemnity payment to the actual facility. Once that maximum's been met, then basically it comes out of the client's back pocket.
Okay, so there's nothing that's eternal about the benefit.
That's correct.
Sooner or later, like my benefit, I think mine's limitations is at right under $500,000 on my own long-term care with myself and my wife. So if I'm starting to burn through it, that might, when I divide up the monthly benefit, that might help me about 6 to 7 years.
Correct.
So when I'm looking at this is, again, we've talked about individual long-term care. This is the way to go. I think the benefits are better in a standalone contract, but not everybody can get the Cadillac version of it.
That's correct.
So let's walk through some of the ways to pay for this. And the first one is, of course, personal assets. We know that. But let's go through the next page, because to me, I think that's where we're talking about family caregiving. Talk a little bit about that.
Well, I've even had some experience with this. My stepmother had to take care of both her mom and dad. It's very taxing on them, both mentally and physically. To see your parents, kind of deteriorate and then eventually pass away is tough. And it's tough on you physically and mentally as well.
Well, so the pro is the person who's actually getting the caregiver is paying no money out of pocket.
Correct.
But the negative is family members are involved. I've seen family members come out of their own pocket. Then all of a sudden their lifestyle changes, because now they're spending so much time giving care that they don't give the same care maybe to their own children or their own grandchildren. Correct. So it's really, I appreciate the family giving. Don't get me wrong. I think families are great. They're the number one. They're the core of our culture. But honestly, family paying for family caregiving, it's really stressful and it's really taxing. How about reverse mortgage? Because I'm all over reverse mortgages. If you need equity and your house is sitting there, I might as well tap it.
Yeah, it's a very popular concept. A lot of national TV advertising is going on with it. It is a good way to do it, but you're burning through that asset, which is the equity in your home. I'm
thinking if I have a actual asset pulling out reverse mortgage, this could maybe pay my premiums for a little while. Maybe not my health. Maybe the way to go on this is to actually have the reverse mortgage pay the premium, correct, not the actual bills every month. Yeah. So I guess if I was saying I don't want to be down on it, I just want to say maybe I'd use it for the premium and not the actual expense or the event. Okay, then there's long-term care insurance itself, the very thing we're talking about today. Now, a couple sessions back, we talked about, hey, this is pricey. We're not going to say it isn't. It is. Talk a little bit about some of the things that we're looking for in a long-term care policy, because we can kind of mitigate some of these costs.
The elimination period or the waiting period, the longer you can stretch it out before you meet that's going to help you. There's things like waiver of premium, a little bit pricey. You might want to consider not having it. And then, what's your maximum aggregate benefit? And then, what type of, facilities, or, is it going to be home health care? Is it going to be assisted living? Is it going to be a full-blown nursing care facility? All affect the pricing of the product.
So I have to really, before I even come and start looking for this, I really need to start thinking in my mind, what kind of lifestyle, what kind of money do I want to spend on this, and see if I can get somewhere in the middle. Because when we talk about this tomorrow and the next day, we'll be talking about linked products, because they're really now becoming the middle class way to go.
Yeah, absolutely.
I just can't really afford this. Now, what about life insurance policy, cash value surrender? I mean, everybody talks about, hey, I have this policy. I have had it forever. I probably have 80, 90 grand in there.
Yeah, it's a decent option to go. Maybe, like you said, using it to pay for the premiums, and maybe even keeping some of that death benefit in force by paying for the premiums versus just actually using the cash value to pay for it.
Now, the positive is if you had to go this route, you could take policy loans from the life insurance contract as long as it's kept in force for the life of the insured, and you can actually tap the equity of that policy. It's collateralized loans to the policy, but you'd actually be able to get that money out free as long as you kept the policy in force for the life of the insured, and you could actually use that for either the long-term care event itself or, as you just suggested, maybe the premiums.
Correct.
What about life settlements? Boy, I'm going to sell my policy because I really don't need the death benefit anymore, and I need that money for long-term care expenses. I'm going to sell that off into the life settlement market.
Yeah, it's been a pretty popular concept. I think you got to proceed with a little bit of caution doing that because, you bought the life insurance for a reason. And, switching gears like that, just make sure when you do it, you're doing it for the right reasons.
And keep in mind that you need to shop this out, but the prices vary so much, it could be between 10 and 15% difference. So you want to get the highest bid. If you're going to do this tactic, just make sure you bid it out. For more information on the material presented in today's show, just click on the landing page address in the video description. We'll be right back with more from Butch Boley.
A solid web presence has never been more important to the success of your business. Introducing Agent Website Creator, provided by CreativeOne. Through Agent Website Creator, you can create your own personalized website and have it up and running easily with zero knowledge of programming. Choose from several designs with easy drag and drop customization. Get proven lead generation offers, professionally written articles, and helpful financial calculators. Plus, the ability to embed videos, integrate your social media, and more. Update your website anytime and show the world within minutes. The best part? It's hosted for free. To learn more about Agent Website Creator, call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, Butch and I are continuing our discussion on how to pay for long-term care. We'll walk you through most of the popular options that seniors are using to deal with their lifestyle changes. Well, let's talk about it because we're just brought up several ways to do it, from reverse mortgages to paying it out of your pocket to hoping maybe your family will pick up the bill. But what we're talking about today is a little bit more different. Viatical settlements, they've kind of gotten pushed back, and I haven't heard that much traffic, but they're still out there. You still can get a settlement. Just give me the pros and cons of that.
Yeah, you can get the cash you need to pay for long-term care insurance or long-term care services. You have control over it. One of the cons is it may be difficult to find a buyer for it. As you mentioned, it's kind of been, it was very popular a few years ago, not quite as popular. And the long-term care cost could exceed how much cash you receive.
Well, then we have accelerated death benefits. Now, a lot of people have life insurance. Some contracts actually embedded in their provisions allow for acceleration of that benefit while you're still alive. Talk a little bit about that. That's kind of a curiosity.
Yeah, single premium life with an accelerated benefit is getting to be more and more popular. It's kind of the best of both worlds. You can take your money in qualified money or non-qualified, put it in, get an increase in your death benefit. Let's say you have $100,000, could increase it to maybe $250, and then you can get up to 2% of that $250 per month if you become deficient to a 6 ADLs, and if you die, to tax-free death benefit.
While we're on this, I'm thinking about a couple of products that came out last year that are kind of changing a little bit of a way we think about the longevity. There's a carrier that will actually let you amortize your death benefit while you're alive at age 85 and actually pay it out. Instead of doing a viatical or an acceleration or an actual settlement, some people are looking at these new contracts as the ultimate backstop for long-term care and nursing home. And they're using it because you can, at 85, you can actually amortize the death benefit. This is why our industry is so creative.
Yeah.
So let's talk about a little bit about our accelerated. We talked about accelerated birth. How about borrowing? I mentioned this before. I'm not going to sell my contract out. Can I borrow from cash values?
Sure you can.
Okay. Now, there's an interest charge to that. It's not free.
Correct.
And I got to keep it in force.
But it's pretty affordable.
Pretty affordable. Let's say, and I know a lot of people, and it depends upon what kind of contract you have, before you think about using your cash values, you may want to look one more time. Is there anybody out there that will take your contract that you may have, especially if you have good health, and if I 1035'd it into a new contract, would the actual loan cost be way less? Because from contract to contract, you could be paying 350 basis points all the way down to almost zero wash loans.
Correct.
So you kind of see where you're going to go on that before you make your final decision. Let's talk about life insurance and LTC. We're going to get into this specifically in the next couple sessions. This is really strange. We have a mortality product married to a morbidity product. It doesn't seem right.
Well, it's something new and it's pretty progressive. Some of the pros are, it helps you provide, that cash to pay for long-term care, gives you control. The negatives may be, the insured may be requiring you to qualify for it because there is underwriting in it.
Well, I got to qualify for the life insurance first.
Correct.
So if I get past that, we still have maybe some knockout questions for the LTC side of that equation.
Correct.
So we'll talk more about that in the next day. Talk about the annuity, because this is the one that actually may have some tax play here.
Yes, correct. Obviously taking withdrawals out of an annuity is going to be taxable. If it's paid with a hybrid product like this, if it's paid for long-term care services, comes out tax-free.
Okay, so I can take, if it's only for that.
That's correct.
So I have to, I'm assuming I'm going to need a paper trail here.
That's correct.
To be able to prove this. Okay, so if I have an old contract, I could I 1035 it to another annuity contract that has this LTC provision?
You sure can.
Okay, so I'm 1035ing, no tax error, because I get to exchange, and I could take my gains out of the contract and pay for my long-term care events or reimbursement as long as it's going directly for that.
That's correct.
Now, well, to me, that may be the way to go. So now we've looked at annuity LTC combo, the life combo. We've looked at viatical settlements, accelerated death benefit, and borrowing from cash values. We've looked at surrendering your life insurance contract, doing a life settlement by selling it, and then LTC insurance, and then even family. I don't want to depend on my family, but that could be, and reverse mortgage. So we've really mapped out some of the most popular ways people are paying for this today. And you have to sit down with a professional that's really, in my view, not only a retirement expert, but one that has his expertise in long-term care. For more information on the material presented in today's show, just click on the landing page address in the video description. And for more information on all our shows, seminars, and workshops, just follow us out on social media or visit us on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.